The major American stock markets have closed down as Trump tariff worries continue to shake investors. The Dow Jones Industrial Average dropped sharply, falling over 900 points at one point today. But history has shown that millionaires are made during stock market downturns, and the bigger the decline, the bigger the opportunity, especially if we can be brave when others are scared. That's the best way to get rich without getting lucky. In this video, I'll show you everything you need to know about this latest market trouble and why it might be echoing one of the most disastrous economic policies in American history, the Smoot-Hawley Tariff Act of 1930, which helped turn a stock market crash into the Great Depression. Your time is valuable, so let's get right into it. I'm not here to waste your time, so here's everything I'll cover in this video. The current Trump tariff announcement and its immediate market impact. Historical parallels with the 1929 Smoot-Hawley tariffs and the Great Depression. What the Fear and Greed Index is telling us about current market psychology. How some of history's greatest investors bought during market panics. And of course, practical strategies for navigating this potential stock market plunge. The current stock market downtrend stems directly from President Trump's recent tariff announcements. As of April 16, 2025, Trump's administration has implemented sweeping measures including a baseline 10% universal tariff on nearly all global imports, with higher reciprocal tariff rates imposed on numerous countries. For China, the effective tariff rate has reached a staggering 145%, creating massive uncertainty for businesses and investors. The S&P 500 index closed at 5,275.70 on April 16th, dropping 120.93 points or 2.24%, the largest single-day percentage drop since April 10th. The Dow Jones Industrial Average finished at 39,669.39, down 699.57 points, or 1.73%. The Nasdaq Composite suffered the steepest losses, closing at 16,307.16, a decrease of 516.01 points, or 3.07%. These indices are now well off their recent peaks. The S&P 500 stood 14.13% below its record close from February 19, 2025, while the Nasdaq was 19.17% off its record high from December 16, 2024. This stock market drop today, we're seeing mirrors the reaction following the infamous Smoot-Hawley Tariff Act of 1930. Back then, Congress passed sweeping tariffs in the aftermath of the stock market crash 1929, which economists widely agree worsened the Great Depression. When President Hoover signed the Smoot-Hawley Act in June 1930, the stock market had already fallen significantly, but the tariffs sparked a renewed stock market plunge and contributed to global trade collapsing by over 66% between 1929 and 1934. As one noted economist at the time warned, those who cannot remember the past are condemned to repeat it. The similarities are striking. In both cases, protectionist policies were implemented during economic uncertainty, triggering immediate stock market losses and threatening global trade relationships. The stock market today reflects extreme fear. The CBOE Volatility Index, VIX, often called the market's fear gauge, is hovering above 30, a level that signals heightened fear and uncertainty compared to historical norms. The University of Michigan Consumer Sentiment Index for April 2025 plunged to 50.8, a sharp 11% drop from March's reading of 57.0, and a 34% decline year over year. This marked the fourth consecutive monthly fall, bringing sentiment to its lowest level since the COVID-19 pandemic's early stages. Consumers specifically mentioned growing concerns about the trade war, potential job losses, and rising inflation as reasons for their worry. What's particularly noteworthy about this market decline is its speed. The S&P 500's 14.13% drop from its February peak has occurred in just about 2 months, developing faster than the average correction timeline of around 4.5 months. Individual sectors tell an even more detailed story. Information technology has been the hardest hit, with semiconductor manufacturers suffering disproportionately due to new U.S. export restrictions targeting China. The automotive sector faces significant headwinds from potential 25% tariffs on vehicles and parts, while consumer-facing industries feel the pressure from rising import costs. When examining how investors have profitably bought during similar periods of tariff-induced market drops, several figures stand out. These successful investors didn't try to predict exactly when the market would bottom. They focused on buying quality companies at better prices when fear was high. Warren Buffett exemplifies this approach across multiple market downturns. During the 2008 financial crisis, when markets were in free fall, Buffett invested $5 billion into Goldman Sachs in September 2008. By providing capital when others were too scared to act, he negotiated favorable terms. Preferred stock yielding 10% plus warrants to buy more shares later. By 2011, this investment had netted Berkshire Hathaway several billion dollars in profit. Buffett famously penned an op-ed in October 2008 titled, "Buy American I Am," urging investors not to panic out of stocks. He wrote, "Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked-down price." This reflected his consistent philosophy. Be fearful when others are greedy, and greedy when others are fearful. David Tepper provides another compelling example. During the 2008-2009 crisis, when banks appeared on the brink of failure, Tepper purchased Bank of America shares when they were trading around $3 and Citigroup debt at approximately 19 cents on the dollar. His analysis led him to believe the government would not let the entire banking system collapse. As the market stabilized, Bank of America's stock climbed to around $15 by late 2009, and Tepper's Appaloosa fund gained an astonishing 132% in 2009. Even during Black Monday in 1987, when the Dow dropped 22.6% in a single day, Buffett was reportedly playing bridge calmly and placing buy orders throughout the day. His reasoning was simple. Nothing had fundamentally changed about the businesses he owned, so a 20% plus drop was an unexpected gift. The pattern is clear. While most investors panic during market turmoil, those with cash, courage, and conviction find extraordinary opportunities in quality companies selling at discount prices. For investors watching the current stock market news and Trump tariff latest developments, several potential opportunities may be emerging. First, technology stocks have been hit hardest, creating potential value. Nvidia, a semiconductor giant, saw its stock fall nearly 7% on April 16th, following a significant $5.5 billion charge related to new U.S. licensing requirements for exporting advanced AI chips to China. Similarly, AMD shares dropped approximately 7% on the same day. These declines may create buying opportunities in fundamentally strong companies facing temporary headwinds. Second, defensive sectors are showing resilience amid the stock market going down. Utilities gained 1.85% in a recent week, while consumer staples rose 1.43%, suggesting these areas might offer some stability during continued volatility. Third, some companies have shown they can adapt to tariff pressures. Tesla, while down 5% on April 16th, produces all its vehicles in the U.S., providing significant insulation from direct tariff impacts, though it still faces higher costs for imported components like batteries from China. Even apparel companies like Nike, Gap, and Levi's, which dropped 10-15% immediately following the April 2nd tariff announcements due to their reliance on Asian manufacturing, may represent value if they can successfully adjust their supply chains and maintain customer loyalty despite potential price increases. The key insight is that tariff impacts will be uneven, creating both winners and losers. And that stock market report data shows excessive fear may be creating mispricing for long-term investors. While there are opportunities, significant risks remain in this stock market right now. First, the tariff situation could escalate further. The current effective rate on Chinese goods has already reached 145%, and further increases could severely disrupt global supply chains and trigger deeper market declines. Second, inflation presents a serious concern. Consumer expectations for inflation have spiked dramatically. Year-ahead inflation expectations surged from 5.0% to 6.7% in April, the highest since 1981. Tariffs essentially function as taxes on consumers, potentially worsening already persistent inflation and forcing the Federal Reserve to maintain higher interest rates for longer. Third, consumer sentiment has plummeted to 50.8 in April 2025, a level not seen since the early pandemic. This sharp downturn in confidence could lead consumers to reduce spending, undermining a critical engine of U.S. economic growth. Fourth, the unpredictability of trade policy makes planning extremely difficult for businesses and investors. The sheer speed and scope of tariff actions, combined with volatile communications, have created an environment where rational forecasting has become exceptionally challenging. If you found this breakdown of the tariff situation and market opportunity valuable, please hit the like button and subscribe to the channel. Your support helps me continue delivering this kind of data-driven analysis during these volatile times, and it guides which topics I cover next. History doesn't repeat, but it often rhymes. The current Trump tariff announcement today and resulting stock market down today situation bears uncomfortable similarities to the Smoot-Hawley era, but it also presents opportunities for prepared investors. Warren Buffett famously advised, "Be fearful when others are greedy and greedy when others are fearful." Today's market clearly shows fear dominates. Buffett, Tepper, and other successful investors have demonstrated that times of maximum worry often present the greatest opportunities through selective buying of quality companies at lower prices. The S&P 500 is now 14.13% below its February peak, while the Nasdaq is approaching bear market territory at 19.17% off its high. These are significant pullbacks that have historically provided good entry points for long-term investors. The critical factor is maintaining cash and emotional discipline when others are panicking. Remember that while the market may remain volatile in the coming weeks, especially with uncertainty around tariff policies, these periods of extreme fear have historically been times when the seeds of future wealth are planted. Thanks for watching to the end, even though I gave you everything up front.